Hey guys, welcome back to another video. Today we're going to be talking about business broker fees or investment banking fees when selling your business. And this is a topic that's not covered a lot in the internet realm or discussed openly. So I thought I'd make this video to give you my perspective as an investment banker in the lower mid market. So my firm, Robley, we primarily focus on businesses between, I'd say, $1 to $50 million in value. And so I can give you my take on the lower mid market and talk about the mid market in general. So this video is going to cover really what the fee structures are, what to expect, and different ways to negotiate and understand the reasoning behind these fees. So hopefully you find some value here. Now, investment bankers and business brokers are usually compensated on a contingent basis, meaning that the majority of their compensation for the work that they do is tied to the successful closing of the deal. And it's similar to a real estate agent. They don't get paid until the sale gets closed. And what this does is it aligns their interests with the business owner who will only proceed with a deal that makes sense for them, right? So it differs greatly from the compensation that, a lawyer or an accountant will charge on an hourly basis because a business sale is a very long dated process. It would not make economical sense for a seller to incur hourly rates for a business broker or investment banker. And the reason why is, investment bankers take anywhere from 9 to, at worst 18 months to sell a company. If you're on an hourly rate for 18 months, you can rack up a ton of fees with very little certainty around the deal closing. So you always work with brokers that are aligned with you because high hourly fees are a way that communicates, I want to get paid, but I don't really care about the outcome of the deal. Whereas a success fee, a contingent fee, aligns the broker's interests with yours because if you don't close on the deal or you're not happy with the deal that they bring to you, then they're not going to get paid. So they're working to make sure that they deliver on your expectations. The only difference where this doesn't apply, the contingent fee structure, is when there's a turnaround situation or where, a bankruptcy, say for example, a company goes through a bankruptcy, there's no real EV, enterprise value to tie a fee to. So it's really more of an hourly consulting engagement. But for traditional sales where you're selling in the open market, it's a contingent fee is necessary and recommended. Now, as I said, lawyers and accountants do not operate on this basis simply because, from their perspective, when they get involved, the deal's already kind of ironed out. The buyer's at the table, and there's a lot more certainty of close. Whereas with the business broker, they get involved very early on in the process, sometimes years before the business actually sells. So for the seller, it makes more sense just to tie it on a contingent fee basis. Now, before we actually jump in, I would rather we talk about why you should pay a broker and be cognizant of the fact that I myself am an investment banker in this space and there may be some bias, but I'm going to try to give you some really good reasons to understand why. And especially if you hire a good broker, it is the equivalent of an insurance policy. And I'll tell you why. So, like a policy, you have the professional care and management of your sale by someone that's good. And that's why I underlined this word good. You want to make sure that you're dealing with someone that's competent and that's experienced. Because if you do deal with someone like that, they're going to make sure to take care of your confidential information. So when you're going out to market and sourcing offers, even if you're dealing with competitors that may use that information against you, that advisor is going to know how to release that information in tidbits, not really give everything up front, because if they're just tire kickers, you gave away really the secrets to the castle and really for nothing. Whereas if you manage that process correctly, you can deal with a competitor but still be fairly protective of your core information until the deal is very advanced to a place where the certainty of close is very high. The other thing is time management. You don't really appreciate the fact of how much work goes into meeting the buyers and answering their questions and the advisors for the 9 to 18 months that it takes to really sell a business. So having a team in place will allow you to focus on running your day-to-day business while the broker works on your behalf to bring that deal to you and help it close. And typically, especially if you're a well profitable business with that's going to attract a lot of interest. What the broker does is, while you could try to sell your business and go to your local competitors or people that are in your network, your neighbor at the cottage that said, "Hey, I'd love to buy your business," kind of thing. But with a broker, they have a very set network of financial and strategic buyers that they can go to create an auction. And when you create an auction, what that does is that it generates a lot of interest, which pushes up the price of the business. And the irony, and I always say this when I meet with clients, is that I'll probably push up the value of your business by 5, 10, 15%. And if my fee is only 5%, you've netted the additional 10% simply because you went with a broker instead of trying doing it by yourself. So I think that's really important to understand and quantify that. Yes, you're paying, say for example, 5%, but the gain in the value of the business by going through an auction is actually more than the net cost to you of paying that advisor. Now, as I mentioned before, the other benefit is, unlike an insurance policy where there's a cost that's fixed, when dealing with an investment banker, a large portion of their fee is contingent on the deal closing. So if they don't deliver a deal that you're comfortable in accepting or that doesn't meet your priorities, there's very little cost that's incurred outside of maybe a retainer fee. And really, you get to understand where the market thinks the value of your business is. You probably get some pretty good feedback on the company from outside investors, which you can then take, repurpose, and change your strategy, and then go back to market a few years down the line. And the cost to you is limited outside of the time that it took to meet those buyers that the advisor brought to you. And then the last thing is it increases your odds of closing. And this is really, really important. In most instances, the deal doesn't fall through before the offer's at the table. Getting offers is one part, but bringing that offer across the line is everything. And that's why some people even pay advisors to get involved once an offer is at the table, because what the advisor does is they play the quarterback role, managing the emotions of the buyer and the seller, engaging with professional advisors to make sure that their concerns are addressed, the closing lawyers, the accountants, the banks and the lenders that are lending into the deal, and managing all of that information flow, all of those questions. They are on all those calls. And going back to the time management point, you don't have to be on those calls anymore because your advisor is there making sure that they're bringing the deal across the line. So these are some of the reasons why you should pay a broker for some fees. Now, let's talk about contingent fee structures, right? Not all fees are the same. And depending on the geographic region, the type of industry that you're in, the size of your company, and the types of brokers or advisors that you're working with, there are a few fee structures. I mentioned the flat fee. The flat fee is very simple. I'm paying you X amount of dollars to get the deal done, and I only pay you X once the deal closes. A modified version of that is I'll pay you a flat fee, but if you can get more value for me, I'm also going to pay you a percentage bonus on that. The third is a percentage fee, and this is the most popular in my business. This is what I use the most. It's a flat percentage fee that allows you to really tie the fee to the value of the company and incentivizes the advisor to get more offers and a higher value to get a higher fee for themselves. There's the old school Lehman fee, and then there's the reverse Lehman fee. The Lehman fee is pretty dated. I don't see it very often. The reverse Lehman fee is actually the second most popular fee structure, primarily in the United States, not in Canada. Because in Canada, you're going to see a lot of percentage fees, whereas in the United States, you're seeing the reverse Lehman fee used frequently. So I'd say maybe about 40, 50-ish percent of the time, you'll see a percentage fee from brokers, about 30% for the reverse, and then the balance is a mix of fixed and flat and hourly and et cetera, et cetera. Now, outside of the contingent fee at the end of the deal, there are also upfront fees that come with the deal. The vast majority of deals, the fees are going to be maybe 80 to 90% weighted on the back end contingent, but there's also some upfront forms of payment that are required. Sometimes there's an upfront retainer, and this varies from $10,000 to $75,000 for a mid-market company. And sometimes it's refundable, or credited against the fee at closing. But in most instances, I would say the upfront retainer is actually non-refundable. And what this does, and I always ask in my own situations for my business, I ask for an upfront fee because from the broker's perspective, it's a great way to get an understanding of how serious the seller is in wanting to go through this process. I have been in countless meetings where I will say, "Hey, listen, our contingent fee is 5% or 6%, and we have an upfront fee of 20,000." And the client hits me back with, "Oh, you know what? If you bring me an offer, I'll pay you 5%, but I don't want to pay you the upfront." Well, hold on a second. How many people have you told that to? I'm probably working with 17 other people that you're speaking to right now saying the same thing, which is you bring me an offer. I have no real commitment to you, no exclusivity to you as my advisor, and I'll pay you if you bring it through. But, I don't really want to incur the upfront. So that communicates a lack of seriousness. So that's why a lot of brokers and advisors will ask for the upfront fee. Something less common is an expense reimbursement. So this could include travel, printing, delivery costs, and this usually works for industry specialists working with more international buyers. Usually there's a limit to the type of expenses that are available for reimbursement without approval, and then there's also an approval list where if you incur above $1,000 in monthly expenses, then you go to the owner and say, "Hey, listen, this is what I incurred. This is the reason why I incurred it. Can you approve and sign off on reimbursing these expenses?" I would say for a lower mid-market business, you're not going to see expense reimbursements being required or needed. And really, the only real need for an expense reimbursement is if the broker is extending the geographic range of that buyer pool significantly. So I'll give you a really good example. We're selling a company that the buyers are actually based in Japan, but the company's based in Canada. So we justified that, hey, listen, we may need to incur travel costs to go out and see those buyers and build that relationship. So that is available as an expense reimbursement. But everything else, if we're meeting for lunch with a buyer here in Canada, that's not considered a required expense under the reimbursement clause. So it's give and take. I would say you see this maybe only 25-30% of the time, but in most instances, you're not going to see that. The other thing that is very common, an upfront retainer, I'd say 9 times out of 10, you're going to see it. And same thing with a monthly fee. Very frequently, the monthly fee is used to amortize a portion of the success fee and ensure that the client is committed to the process on an ongoing basis. So the upfront fee usually pays for the costs of developing the CIM, the confidential information memorandum, and the data room, and the upfront costs of spending, a month or two with the business owner learning their business as the advisor. The monthly fee is an ongoing fee that gets incurred and amortized against the success fee as the advisor goes out into market and starts meeting with buyers and sourcing offers and all that. And when I say amortize against the success fee, what that means is that, if, say, for example, the upfront fee is $20,000 and then I have a $5,000 a month monthly fee. The $20,000 a month is out of pocket, regardless if the deal closes or not, the advisor is entitled to keep retaining that fee. Whereas with the monthly fee, in most instances, it's actually refundable, and only if the deal closes is it credited against the success fee. So, if the advisor took 9 months to find an offer, and give or take, say for example, the fee was $1,000 a month, then he or she incurred $9,000 up to the day of close, which is deducted off the success fee of, say, $100,000. So you've collected the $9,000 on a monthly basis for the 9 months, and then the $91,000 net fee is paid at the end of the deal. Now, say, for example, you incurred $9,000 for 9 months, no deal came through, and you decided to terminate the agreement. That $9,000, if refundable, would be paid back to the client, or in some instances, if it's not refundable, it would still be held on to by the advisor. And so the net cost to you as the seller in attempting to sell your business was the upfront fee and the monthly fee, but nothing else. And it's obviously for 9 months of work to pay $19,000 all in is nothing. The advisor made nothing on that engagement, really. The time they spent on the engagement was probably a lot more than that. So that's why it works. There's such an alignment to make sure that a deal gets done and across the line. Now, let's talk about the flat fee structure first. Flat fees are very good fees when there's a probable buyer or group of buyers identified by the seller. And what essentially the broker is doing is playing the role of deal closer and negotiator. So there's no broad search in place. It's not like he or she's knocking on a ton of doors to generate interest. There's a set group of buyers that they reach out to, and it allows them to quickly get that offer and get the deal closed. And the flat fee structure obviously limits the incentive of the broker to seek more value for the business, as they're not incentivized to fight for that extra dollar that a variable fee would allow them to. So, typically what ends up happening is you don't see a lot of flat fees in general. So sometimes what you'll see a flat fee plus a little bit of a performance bonus. And I'll give you a live example. I'll give you a live example. So, Dave owns a software business. He recently received an unsolicited offer for $10 million. His accountant tells him, hey, listen, you have to go find an investment banker to either A, see if that offer is good, and B, if it is good, get it across the line and use someone that can negotiate on your behalf. So the investment banker comes in there and they say, hold on a second, this $10 million is really, really good. It's a competitor. They're credible. They have the ability to close. I see this as a great way to really take this offer and try to get a bump on it. Maybe go back to market and get some more offers and try to get this competitor increase their offer. So if the 10 million comes through, my fee is X and it's fixed. But if I get you an extra $1 million, I want my fee to increase and to be a bit variable. And I want 10% more on that fee. Now that percentage is, I just picked it out of the air. It could be 5, it could be, 7, 2, whatever it is. But the point of the structure is that, flat fees work really good when you set an upper threshold limit of saying, in this scenario, the market told you the business is worth 10. You bring in the broker and now you say, listen, if you can beat 10, I'll give you more. But if you can't beat 10, then I'll only pay you for the hours that it takes to close the deal and negotiate it. So it really works in that scenario. Now, percentage fee structures are the most popular fee structure, and it's commonly accepted across the industry and understood by all because it's very similar to the real estate agent type structure. It's a variable fee. I myself and my firm do the same thing, where I would say 99.9% of the time, a fixed percentage fee structure. And what this does, it aligns the broker with the client as they get a percentage of the deal value. So negotiating and seeking a higher deal value results in a larger check for the broker, and obviously the net value for the seller is also increasing. So to give you a simple example, if it was a $4 million business, EV, we get an offer for $4 million, give or take, it should be about a 5% fee on that, which is a $200,000 net fee to the advisor. Now, in this scenario, if I get an extra $1 million on that, that fee goes up to $250,000. So I'm not incentivizing closing the deal fast. I want to go out to market, see what the market dictates is the value of the business, try to get more and push for more. And obviously, if we hit the upper threshold and the market says, yeah, I'm not going to pay more than $4 million, then close on that deal and get the $200,000. Now, one of the downsides that we typically hear, I hear this all the time from accountants, is that, listen, at the end of the day, how much work does it take to get the first 3 million of that $4 million value? And what that means is that, especially for bigger businesses, yeah, obviously that business is worth at least $15 million. So, what real work are you putting in to get me the first 15? Yeah, if you get me an extra, $5 million on top of that, yeah, you probably created an auction, worked really hard to find the right buyer and get that extra $5 million. But the first 15, anyone would buy this thing for at least $15 million. So that's why sometimes people argue and say, hey, hold on a second, with a fixed percentage fee, the broker, the value that they're adding is the last $3 million of the $30 million deal, for example, because the first 27, you're going to get that from anyone anyways. So that I think is one of the complaints. So my answer to that, being in that room, is that, hold on a second. Anyways, you would have paid a flat fee for a deal. We go back to the other example where I would say, fine, pay a flat fee plus a variable comp on anything above that, or just pay a fixed percentage fee, which would be the equivalent to the flat fee plus the variable. So give or take, it all nets out to the same. And I'll give you some market stats later on. Obviously, if this thing was 15% of $4 million, the broker is grossly overcharging the client. But at 5%, give or take, you would get the same net fee, whether it was a flat or more of a fixed percentage. But it is a fair argument to say, how much work does it really take to get the first 27 of that $30 million business? Now, the Lehman fee is another structure where it's unique in the sense that this was incorporated, I think, in the 70s and 80s in Wall Street when M&A was a much smaller business, and the success fee declines incrementally as the value of the business increases. So what that means is, if I get more and more dollars, my fee on the extra dollars declines. So on the first 2 million, say for example, I get 5%. On the next 2 million, I get 4%. On the next 3 million, I get 3%, and on the remaining balance above $6 million, I'm only getting 2% versus just a flat fee. Now, the traditional Lehman fee is dated, and we don't see it frequently in Canada. I've never seen it actually, and in the U.S., it's very uncommon to see, because the underlying assumption of this fee structure is that the market will drive the price higher, not the broker. So why should the broker be rewarded for the extra value that they generate as the value of the business increases? Now, it puts an emphasis on the broker closing the deal, getting the deal done, but not getting a higher value. Because obviously, why should I fight more if I'm only getting 2%? Realistically, it doesn't really push the broker. And in the 80s, it worked because auctions in the lower mid market were so limited. There were so few buyers available. It was like 3 or 4 people. And, all the clients were saying was, hold on a second. All you're doing is delivering a service and going through the motions. Why should I pay you just generally for, the increasing value of my business if the market and the rising tide lifts all boats? But this just doesn't make sense nowadays. Nowadays, the lower mid market is so busy with a ton of buyers, a ton of capital looking to buy businesses. Brokers should be incentivized. It is in your interest as a seller to try to get your broker to get more offers and increase the value of the business and pay them more, because that's how you get them incentivized. So that's why the reverse Lehman fee exists. And it's the exact flipped version of this. On the first $2 million, or on the first $4 million, you're getting 2%. On the next $2 million, you're getting 6%. And everything above $6 million, you're getting 8%. Well, hold on a second now. If I bring in another $1 million, I bring a $7 million offer. On that extra million, I'm getting $80,000. Whoa, that works. And especially, I would say, in the kind of $10 to $50 million business value range. The multiples are such in flux, because with small businesses, it doesn't work. There's not a lot of buyers. And with mid-market or large cap businesses, the market's fairly set. You kind of know where values are because you can see the publicly traded stock valuations as comparables. But in the mid market, if I were to call it that, the 10 to maybe $100 million, multiples vary. It could be 4 times, it could be 9 times. So, incentivizing the advisor to get more really works. And so that's why the reverse Lehman fee is actually the second most popular structure in the lower mid market today. So in this scenario, you can see an immediate difference in the comp. If you get a $5 million offer, the reverse Lehman fee would generate 140 versus 150K for a flat fee of 3%. If you bring in an extra $3 million, the compensation all of a sudden outpaces the flat fee, and now you're making $280,000 versus $240. So it incentivizes the advisor to get that extra $3 million, and it makes sense. Now, there are some other things to consider when thinking about fees and meeting with brokers and getting an understanding of what the market is there. My first comment right off the bat is, don't be their smallest client. So what that means is big established banks and investment banks are not going to be desperate for your business if you're a very tiny client. If you're a mid-market client, you need to make sure that you have the negotiating power and find investment banks and business advisors that match the size of your business. So say for example, you wanted to deal with a JP Morgan, but you were a $10 million enterprise value business. JP Morgan would look at that and say, A, either you're too small, I wouldn't even take you on, or B, fine, you're small enough, you're big enough that I'd take you on, we'll make some money on it, but I'm not going to put my best staff or my top guys on it. You're going to be the bottom of the rung in terms of our priority list. So I would say it's important to match the size of your business with the scale and prestige of the investment bank. If you're a $1 billion business, go ahead to JP Morgan. If you're a $10 million business, find a local investment bank that has experience in your sector and deal with them. The other thing is read the fine print. So a really important difference is that most sale engagements will have a tail. And it is a common way to protect brokers and investment bankers if a client terminates the agreement and then tries to sell to the same buyer 6 months down the line to skip out on the fee. Typically, a tail is a way to make sure that, hey, listen, yes, I'll bring the buyer to you. And if you close within 1 or 2 years with that same buyer, I still get my fee because, hey, I brought that buyer to you and that was a brand new buyer that got to see your business and was interested in going through with it. Now, just be cognizant of the fact that the tail's not too long. I've seen some situations where tails are 3 years or like 5 years, and that's just way too prohibitive. It's way too long. We typically see anywhere from 1 to 2 years. Some of my engagements have tails of 1 year, some have 2 years, depending on the industry. But I'd say 1 to 2 years is your standard. And in general, my piece of advice with broker fees is don't be cheap. Don't step over the dollar to pick up the nickel, because if you're trying to grind on fees, as I said before, you want to hire a broker that is very good, high quality, has experience in your sector, because they're your insurance policy. A, they'll take care of the process cleanly and handle it correctly. And B, if they're really good, they'll probably push up the value of your business, and the net impact to you is actually a positive. I'll give you a good example. So we were trying to sell this business in Canada. It was a $6 million manufacturing business. My firm Robley goes in and we pitch against some of the big accounting firms, Ernst and Young, PwC, the like. And so Ernst and Young and PwC, for them, the size of the business was a little too small, but they still got involved. Whereas for my firm, it was a perfect size. That's the sweet spot. We love these types of businesses. And so the way I communicated my fee structures is I said, listen, at the end of the day, my 6% is the simple message is, I believe you think the business is worth $6 million. Slap on top my fee of 6%, and then I need to beat that number. And we did. We delivered almost, I think it was a $8.2 million offer that closed, and the net impact to him was, on top of that 6%, he then probably walked away with an extra $1.4 million. So it was obviously a good example of where, when you kind of quantify the fee and the net impact of that fee to you as a seller, why not pay that 6%, create that auction, get buyer interest up, and extract more value from the market. So don't be cheap. Now, what are some questions that you should ask brokers and advisors when talking about fees? So the first one right off the gate is, how many engagements are you working on? And what that means is, how many clients do you have today? Have a good understanding of their firm. Obviously look on their website and see how big their team is. And if, say, for example, they only have 3 people working for the company, you want to kind of look at that and then compare their answer to the team that they have in place. So if there's 3 people and they're working on 25 engagements, man, they're underwater. There's no way that they're investing and allocating evenly time across all 25 engagements to do a good job. So the busier they are, though, the challenge with that from a fee negotiation perspective is, if they're really, really busy, they're probably or the market in general is really good. And from their perspective, they're probably less willing to negotiate on fees, because obviously, hey, listen, I'm not going to go drop my fees below what we typically sign clients up for if I'm so busy. I got 25 other engagements I got to work on. So it's a double-edged sword. On the one hand, it's a question of quality of service, if they're very, very busy. But on the other hand, from a fee negotiation perspective, they probably are not going to drop their fees in most instances because, hey, listen, I got all these other fees. Now, say, for example, they're worried about the next dollar to pay for rent, they're probably going to drop their fees. So if they have a team of 10 and they're working on 5 engagements and, they say, oh, the market's a little slower than usual, then you probably have more negotiating power to say, you know what, I want to work with you and it will be a good thing for them. But I actually want to drop my fees by, a percent or so. And you'll probably get away with it. Now, another key question is the close rate. What is your close rate on the deals that you've taken on in the last 3 years? And you can ask that about the firm in general or about the individual representative that you're speaking to, because they're probably going to be handling your file. In most instances, a standard average is 60-70% close rates. If it's below that, in general, you should stay away from that advisor. They're probably just taking you on, getting the non-refundable retainers, sitting on you for 9 months. The owner says, hold on a second, you've brought me no real decent offers, terminate the contract, and they walk away with just the retainer, which some people totally do that. We know some firms, I won't name names, but we know some firms that will sign up literally 100 clients a year, take all the retainer fees, walk away with $2 million in gross, incur very little cost because they didn't put in the work to source the buyers, and they make a perfectly fine living off that. Now, obviously, eventually time will run out on that strategy, but if you ask them their closing rate, they will probably say it's in the 30s or 40%, which means you should probably not deal with them because they'll do something like that to you. Not all the time, but in most instances, that is the case. Now, the other thing is, how many people do you expect to work on the file? And what that means is, if it's the entire firm, it's only 3 people, then evenly, if you split up that fee, that's a lot of money for you guys. But say, for example, they have a team of 20 and they're only dedicating 2 people to that team, they will look at that and say, either you want more people on the file, in which case our fees will be bigger, big teams equal bigger fees, or I'll staff 2 juniors on your file and I'll keep the fees at the same rate, but you're probably not going to get the best service. So you got to be cognizant of how many people work on your file. Big teams equal big fees, but if a big team's staffing a lean team on your file, you got to question the quality of service there as well. And then the last thing is references. When you're interviewing brokers or advisors, always ask for references in general. But when you're asking for references, don't. It's not proper etiquette to ask specifically for a fee. And either way, the past client has signed an NDA with the broker so that they won't be able to disclose the fee. But the key question I would ask if I was in your shoes is, generally, were you happy with the value that you received for the fees that you paid? And that question is broad enough that it doesn't breach any NDAs that the past client may have signed, but it's enough to give you an indication of, oh, these guys were really happy. Oh, yeah, no, yeah, totally, no, fine. Or it's like, and they kind of hesitate. You probably can read the room and seeing, yeah, they probably had a problem with the fees there. So that's another really great way to get a perspective from a past client. Now, the last portion of this presentation is going to just talk about the market statistics. So Firmex is a financial services company that really tracks the M&A sector. And since about 2016, they've actually published a free report. You can go online, Firmex Fee Guide, and you can pull the report itself. And they put this report up, and it's a fee guide comparing the average fees across the lower mid-market space, typically for companies that are valued about $1 to $100 million in value. And in 2020, which is the report that I'm using, they asked about 309 business brokers to share their fee structure and their average fees, across North America. So it's a really good kind of proxy to give you an understanding of where the market stands. So I'm going to kind of drill in on 2 key areas. The first is the structure, as we discussed. And you can see here, the simple percentage, which is that fixed, 4 or 5% on EV. There's the scaled percentage, which is essentially the reverse Lehman. And they didn't use reverse Lehman here, but it's essentially scaled, 2% for the first 2 million, 4% for the next 2 million, 6% for the next 2 million kind of thing. Then there's the Lehman formula, as I said, which is the flipped of that, the declining scale. And then there's other, which could be a flat fee or whatever it is. But you can see there's the other and the older school Lehman formulas are not busy. The 2 very popular ones are the simple percentage at 43% and the reverse Lehman at 39%, with the Lehman very, very low. Now, the other really good piece of information that this report shares with you is they identified the average success fee for various deal sizes. And again, this is based on 309 respondents from both the US and Canada. So on the left, you'll see here the average value of the transaction. So a $5 million company or $150 million company. And then there are different tiers based on the fee. So give or take, these are essentially the total fee relative to the value of the business. So if you wanted to keep it simple, it's a fixed percentage fee. A fixed percentage fee for a $5 million business, the two most, the highest percentage areas, about 42% of all $5 million deals for these 309 people were 4 to 6% all in fees, which is super consistent with what I have. Like, I can confirm this is dead on. I'm working on a $4 million engagement where the fee is about 5.5%. I'm working on a $17 million engagement where the fee is 4%. And then we had one past engagement where the fee was 2% on a $40 million transaction. So this is dead on. And this is super valuable to kind of see, hey, where are the fees relative to what I'm where I'm seeing the value of the business. Oops, I'm just going to push back here. So as you can see, a $5 million deal, if the broker is charging 6 to 8%, they're probably an industry specialist. They're very busy. They have the perfect buyer for you, and it may be worthwhile to engage at that level. But if they're a generalist that's taking on your engagement, a 4 to 6% fee is a lot more realistic. Now, as the value of the transaction increases, you can just see, there's almost that inverse relationship. The value of the business increases, the size of the fee declines proportionally. So a $100 million plus engagement is going to be in that 1 to 2% range at most. Very rarely are you going to see these fees go up to this level. And the reason why is typically a larger engagement, they have more negotiating power, and the total value of the relationship to the investment bank is a lot more, right? Like, there's going to be the wealth management business. There may be the underwriting relationship to sell some bonds to the general market. And the investment banks that work on these $150 million businesses are not, three guys working on small businesses. It's a large professional investment banking corporation with a publicly traded markets group and a wealth management division and blah, 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 and blah, blah, blah. So, really, that's why these investment banks can justify charging lower fees on the success fee, but winning more fees on all the other things that comes with the transaction. So that's really it for today. Hopefully you found the video helpful. If you have any questions, just please comment below. Or if not, you can reach out to me if it's more of a personal situation relating to your transaction. You can reach out through LinkedIn, or you can go to my website, Rob Lee Capital, and hit me up over email. If you found the video helpful, please do like and subscribe to the channel. I will be releasing more of this content, M&A, commercial banking content in the future. And also consider signing up for the Finance Kid newsletter. The link will be in the description of the video below, and it will allow you to kind of keep up to date with the different case studies and businesses that I'm working on, just in general for finance related type M&A transactions. So outside of that, have a great day, guys, and take care.